Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Understanding e-commerce financing. E-commerce financing is a funding service that provides capital to online sellers, allowing them to cover expenses or invest in their business growth. It can help support marketing activities, inventory costs, and operational expenses, ensuring the smooth functioning of your online business. When you need financing for your e-commerce business, you have two primary options: debt financing and equity financing. In debt financing, you agree to borrow money at a fixed or variable interest rate. Your business is responsible for repaying the amount and interest over a set period, but the lender does not exercise control over your business. Alternatively, equity financing involves selling a portion of your business ownership in exchange for capital, which may affect decision-making and your potential for profit too. Choosing the right lender is crucial in securing e-commerce financing that suits your business needs and growth plans. Lenders may include traditional banks, alternative funding providers, or online platforms that offer business loans tailored to e-commerce businesses. Make sure to explore and compare different lenders to find the most favorable terms, such as interest rates, repayment schedules, and potential fees. Before obtaining a business loan, it's essential to understand how the interest and repayment terms will affect your business's cash flow. Most loans come with either fixed or variable interest rates. Fixed rates remain constant throughout the loan term, making it easier for you to budget and plan for repayment. On the other hand, variable rates can change over time in accordance with market fluctuations, which might make long-term financial planning more challenging. As you consider e-commerce financing options, it's critical to evaluate how they align with your anticipated growth trajectory and overall business strategy. Make sure to select a financing option that meets your business's unique needs and ensures liquidity without compromising control or long-term profitability. By understanding the various forms of e-commerce financing available, you can make informed decisions that support your online business and help facilitate its sustained success. Types of e-commerce financing. There are various financing options available to support your e-commerce business. In this section, we'll discuss 6 common types of e-commerce financing: business loans, merchant cash advances, venture capital, equity financing, invoice financing, and revenue-based financing. Business loans are a common funding option for e-commerce businesses. You can approach banks or alternative lenders to secure a loan with either a fixed or variable interest rate source. Repayments are typically made on a monthly basis, and the borrowed amount is subject to interest. Business loans can help you cover a broad range of expenses, such as inventory, marketing, and operational costs. Merchant cash advances provide a lump sum payment in exchange for a percentage of your future credit or debit card sales. This type of financing is tailored for e-commerce businesses with strong credit card sales, offering flexibility in repayments. The loan is paid back by deducting a percentage from your daily credit card transactions, providing your business with improved cash flow management. Venture capital is a form of equity financing, where investors offer capital in return for a stake in your business. Venture capitalists, VCs, typically invest in high-growth startups or businesses exhibiting strong potential. However, securing venture capital funding can be competitive, and often requires you to relinquish some control of your company to the investor's source. Equity financing enables you to raise capital by offering shares of your company to investors. Unlike debt financing, equity financing doesn't require businesses to repay the investment, but it does result in a loss of ownership. This option can be a suitable choice for those seeking long-term funding or funding during the early stages of their business. Invoice financing is an option for e-commerce businesses selling to other businesses, B2B, and allows you to borrow against outstanding invoices. This type of financing lets you access cash quickly by advancing a percentage of the value of your outstanding invoices. Once your clients pay their invoices, the loan is settled source. Revenue-based financing has gained popularity among e-commerce companies in recent years. This alternative financing method provides funding based on your business's future revenue source. You receive a lump sum payment in exchange for a percentage of your future revenue for a set period. This type of funding provides flexibility as repayments are dependent on your business revenue, alleviating some financial pressure during low sales periods. By exploring these various e-commerce financing options, you can identify the most suitable funding solution for your business and its specific needs. Determining financing needs. Before you dive into the world of e-commerce financing, it's crucial to determine your specific financing needs. By doing so, you ensure that you're selecting the most appropriate funding option for your online business. To start, analyze your current sales and revenue figures. These numbers will give you an insight into your business's financial health and the potential growth you can expect in the upcoming months. Be sure to consider any seasonal trends or fluctuations in demand that may impact these figures. Next, examine your expenses, including operational costs, employee salaries, and any other general overheads. This will give you an understanding of the actual cost of running your online business and highlight areas where you could potentially cut costs or streamline your operations. Taking a closer look at your stock levels is also essential. Efficient inventory management ensures you have enough stock on hand to meet customer demand, without tying up too much capital in unsold items. By finding the right balance, you can optimize your cash flow while still offering a wide range of products to your customers. This may involve seeking short-term financing to cover the costs of purchasing stock ahead of peak sales periods. Once you've assessed your sales, revenue, growth, expenses, and stock levels, you'll be better equipped to identify the type of financing that suits your needs. Whether you require short-term funding to cover operational expenses or long-term capital to fuel growth, understanding your specific financing needs is a vital first step in securing the right e-commerce financing solution for your business. Remember, staying focused on your objectives and being realistic will help you make well-informed decisions in your journey towards online business success. Importance of credit score. Your credit score plays a crucial role in securing financing for your e-commerce business. It serves as an indicator of your financial behavior and borrowing capabilities. Lenders, be it traditional banks or alternative financing providers, assess your credit score before approving or denying your loan application. A good credit score showcases your credibility as a borrower and increases your chances of obtaining suitable loan options. Lenders prefer applicants with a solid credit history, as it assures them that their investment is secure. With a strong credit score, you can access a wider range of financing options, benefit from lower interest rates and flexible repayment terms. On the other hand, a low credit score might limit your options when seeking financing. Lenders might perceive you as a high-risk applicant and offer a lesser amount than requested or charge higher interest rates. In some cases, having a poor credit score could lead to loan rejection. Besides impacting your loan options, your credit score also affects other aspects of your business. For example, suppliers may extend favorable trade terms if you have a good credit reputation. Therefore, it's essential to maintain a consistent, positive credit history by paying off debts on time and keeping your credit utilization rate low. In conclusion, your credit score is an influential factor when it comes to e-commerce financing. Ensuring a good credit standing can help broaden your loan options, allowing your business to thrive in a competitive landscape. As a business owner, keep an eye on your credit score and take steps to improve it over time, as required. Application process for financing. When you start searching for financing options for your e-commerce business, it's essential to understand the application process. Here's a brief guide to help you navigate the application process with confidence. To begin, you will need to identify the most suitable lender for your e-commerce business. Various options are available, including traditional banks, alternative lenders, or even e-commerce financing solutions like merchant cash advances or lines of credit. Conduct thorough research to find the one that best aligns with your business needs and growth goals. Once you've decided on your preferred lender or financial product, it's time to prepare your application. In most cases, your lender or financial institution will require a well-structured business plan. A solid business plan should include your financial projections, target audience, marketing strategies, and an overview of your products or services. Make sure your business plan is clear, concise, and demonstrates your dedication to expanding your e-commerce venture. During the application, you may need to provide your financial records. They will give the lender insight into your business's performance, cash flow, and overall financial health. Additionally, your personal credit score may also be considered, especially if you're applying for a loan from a traditional bank. To ensure a successful application, be prepared to offer collateral or a personal guarantee. A personal guarantee is a legally binding agreement in which you pledge to repay the loan if your business fails to meet its payment obligations. The collateral you pledge could be your business assets, such as inventory or equipment, or even personal assets like your home or car. When evaluating your application, the lender will assess various factors before determining the interest rate applicable to your loan. The rate depends on the risk associated with lending to your business, your credit score, and the overall strength of your business plan. Keep in mind that a strong business plan, healthy financials, and a good credit score can positively impact your interest rate and increase your chances of obtaining financing. In conclusion, the application process for e-commerce financing may seem a bit daunting, but with careful planning and a clear understanding, you can confidently navigate it. With your research done, a compelling business plan, and accurate financial records, you'll be well on your way to securing the right funding for your e-commerce business. Repayment options. When it comes to choosing repayment options for your e-commerce financing, it's essential to understand the different possibilities and select the one that best suits your business. In this section, we will discuss various repayment options that you can consider. One common repayment method is the fixed monthly repayments. With this option, you pay a fixed amount each month, usually consisting of principal and interest. The loan duration, interest rates, and repayment amount will be agreed upon with your lender at the beginning of the loan. This option will help you manage your cash flow better, as you know exactly how much you'll be paying each month. Another option is the flexible repayment schedule. This method allows you to make repayments based on your business performance or cash flow situation. For instance, during high revenue months, you can opt to make higher repayments, while in months with lower income, you can reduce your repayments. Some lenders may offer interest-only repayments or even payment holidays in specific circumstances. In some cases, you might consider a percentage of your revenue as repayment. This option is particularly relevant for e-commerce businesses opting for revenue-based financing solutions, such as merchant cash advances. You repay the borrowed amount by allocating a fixed percentage of your daily or monthly revenues. The repayment duration depends on your sales performance, with no fixed deadline, making it suitable for businesses looking for flexibility. If you prefer a quicker repayment plan, you can choose the lump sum repayment option. This method involves paying the entire loan amount and any accrued interest at the end of the loan term. Keep in mind that opting for lump sum repayments may lead to a higher total cost than monthly repayments, due to the interest accumulating over time. Lastly, before deciding on a repayment option, be sure to compare various loan products and their respective interest rates. Understanding your financial situation and your business needs will help you find the best fit for your e-commerce financing journey. Role of e-commerce platforms in financing. E-commerce platforms play a crucial role in the world of financing for online businesses. They offer various solutions that can help you manage and grow your online store. Let's discuss some popular platforms and how they contribute to e-commerce financing. Shopify is a powerful e-commerce tool that allows businesses to accept payments through their platform. Amazon is another e-commerce giant. Stripe is a popular payment processor for online businesses. WooCommerce is a flexible e-commerce platform built on WordPress. Although they do not provide direct financing services, they offer integrations with a variety of payment providers that can support your financing needs. Additionally, third-party lenders are available to provide financing to WooCommerce retailers. In summary, e-commerce platforms have become instrumental in providing financing options for online businesses. With services tailored to specific needs and straightforward repayment processes, it becomes easier for you to access the resources required for growth and success in the e-commerce world. Emerging trends in e-commerce financing. As an online business owner, it's crucial to stay updated on the latest developments in e-commerce financing. By understanding these trends, you can make informed decisions on which funding options will most effectively support your needs. Technology advancements are reshaping the e-commerce financing landscape. Innovative platforms are emerging that digitize the application and approval process, making it more efficient and accessible. Coupled with AI-powered risk assessment tools, lenders can now quickly and accurately evaluate your business's financial health. the increased efficiency will enable you to access funding faster, promoting continued growth for your online store. The rapid growth of online businesses has also led to an expansion of available funding options. Traditional debt financing, such as loans and lines of credit, remains a popular choice. However, alternative funding solutions are gaining traction. Platforms like Clearco and Shopify Capital specialize in providing tailored funding options for e-commerce entrepreneurs, meaning you can now access capital that is specifically designed for your business model. Crowdfunding has become a popular way of raising funds from a large pool of investors. It offers the added benefit of validating your product or service idea through actual consumer interest. Platforms like Kickstarter and Indiegogo facilitate the launch and marketing of crowdfunding campaigns, providing you with invaluable exposure to potential customers and investors. Equity investing has also evolved in response to the growing e-commerce market. Venture capital firms and angel investors offer equity funding for promising e-commerce ventures in exchange for a share of your company. As investors share the risk, they're also motivated to contribute their expertise, networks, and resources to support your business's growth. In conclusion, staying informed of the emerging trends in e-commerce financing allows you to make strategic decisions regarding the funding options best suited for your online business. By considering technology advancements, online business growth, creative funding solutions, and equity investment opportunities, you can better position your company for success in today's competitive market. What are common types of financing for online businesses? There are several common types of financing options for online businesses, including merchant cash advances, lines of credit, bank loans, and bank overdrafts. Each option has its own advantages and disadvantages, so it's essential to evaluate your specific needs and requirements when choosing a financing option. For example, a merchant cash advance might be more suitable for businesses with fluctuating sales, while a line of credit could be useful for managing working capital more effectively. How can one apply for an e-commerce small business loan? You can apply for an e-commerce small business loan by identifying a suitable lending platform or financial institution, and submitting the necessary documentation and information required by the lender. Typically, you'll need to provide details about your business's financial performance, credit history, and future plans. Some lenders may also require a business plan, proof of ownership, and personal financial information of the business owner. Which platforms offer loans for online sellers? Several platforms and financial institutions offer loans specifically designed for e-commerce businesses. Each platform has its own eligibility criteria, lending terms, and loan offerings, so it's crucial to research and compare different platforms to identify the most suitable option for your online business. What factors determine eligibility for e-commerce financing? Eligibility for e-commerce financing depends on various factors, including your business's creditworthiness, financial performance, operational history, growth potential, and repayment ability. Lenders may also consider your personal credit history and the overall industry outlook. Different financing options may have specific eligibility requirements. For instance, some lenders may prefer businesses with a minimum annual revenue or a certain number of years in operation. Are there specific grants available for e-commerce businesses? While there aren't typically grants specifically designed for e-commerce businesses, you may still be eligible for general small business grants. Government agencies, non-profit organizations, and private entities may offer grants for various purposes, such as business expansion, innovation, or promoting specific industries. It's important to research and explore available grant opportunities that align with your business goals. How do revenue-based financing options work? Revenue-based financing options provide funding to e-commerce businesses in exchange for a percentage of their future revenue. This financing model offers a more flexible repayment structure, as repayments are based on a business's actual revenue instead of fixed monthly payments. Typically, this type of financing option is suitable for businesses with a strong sales history, consistent revenue growth, and a clear plan for using the funds to improve their operations or marketing efforts. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.